welcome guys to the second episode of Investors Lens. This is the second episode of us with Lusimadio as we talk about the investor and some of the tips that will help you, especially in the market, in analyzing the market and also analyzing businesses as a future investor or as somebody who's looking for an investor. So today's topic is market mechanics. Market mechanics meaning things that affect the market, whether it's stocks, whether it's investment in agriculture, investment in real estate. It really doesn't. What mechanics actually play a role in the short term and in the long term of the whole mechanic dynamics in the market system. So welcome, Lusimadio, to episode 2. We're hoping we can break down this really technical part of the episode into something that people can actually understand. Especially since in the last episode you said it's better to invest in stocks than forex. So how do we go about that? Yeah. Maybe you can say something.
Yeah, thanks, man. Thank you very much again. Yeah, I think there's a lot of realities behind this thing. I know some people would always say, oh, why should we invest in stock and not forex exchange? You know, people, especially those who are into trade, and they know exactly that when it comes to forex exchange, it's a short game, right? It's a short-term game. You know, you can make a lot of money on forex exchange in seconds, minutes. You get it, right? But the thing is, there's a problem there. The reason why I advise people when you're starting an investment and you want to get into stock market, for example, try buying stocks or buy shares of companies that are doing well, and instead of trying to buy or try to trade currency, right? I always say that. Why? Because there is way more security when it comes to shares, right? Because a share price, even if it goes down to zero, you still own it, right? You still own the shares. It's not like if the share price goes down, then you have lost money. You haven't. I would say, hypothetically, you haven't lost money. But why? Because you still hold on the shares. It's still under you. It's yours.
Yeah, you still have a part of ownership.
Yes. Yeah. So it is up to you to decide to sell it, because the only time you actually know that you have lost money is the time you sell the shares. If you sell the shares below the price that you bought it, then you know that you have lost. But if you still hold on the shares and you haven't sold it, it means you don't know basically if you have lost or not. It's just the price of the share that is low based on the market volatility. That's all. But if you wait and hold on it for some time, that price might double, triple, and then you make more money out of that shares if you want to sell it when the price is high, right? Now the thing is that you can, as a new investor, and you're trying to get newly in the investment space and you want to trade in the market, you need to start with stock market first. Buy some stock, buy some shares of companies that are doing well, hold on it for some time. Then at least it's a low risk because you still hold it, you still have it, and it's certain that anytime it's gonna go up. Okay, so you hold on it. But now when it comes to currency exchange, everybody knows you have 99% of losing your money. There's no possibility that there's no excuse someone will come and tell you that if you trade on currency exchange, you're going to make money. No, whoever tells you that is lying to you. I'm talking out of experience. I've lost money, like money in currency exchange. So for you to be able to make money in currency exchange or forex exchange, there are knowledge available, there are information available, there are techniques that some of the forex brokers apply in order for them to be able to get what they want. And in the space of forex exchange, there's one thing that we call market manipulation, which is a dark technique that many of brokers, especially those that are working in a high level with politicians and like high level government officials that are in the trade space, they use that market manipulation in order to ensure that they make money for their clients, but it is not how do you call an advisable technique, because it's basically a crime. It's basically illegal to apply that.
Actually, that actually goes to the first question I wanted to ask. Beyond the news headlines, beyond what people see on the news, what actually makes stocks go up and stocks go down? Beyond what's like, one technique is what you've actually said, the market manipulation, where people manipulate market to suit it. What are some of the other things?
Okay, I'm gonna give you guys three which are very popular, right? Three that are very popular. Number one is the capacity of a company to pay its debts or its operational cost. So that comes down to liquidity ability, right? Or liquidity ratio or rate, depending on how people you want to understand it. So if for example you own a shares of MTN, like that, what happens is that you get to a point that you own the share and you're living with the share, right? But now you have what you call, maybe I'll put it this way, MTN is having issues with paying its debt. It's floating with debt. They can't pay the shareholders. The operational issues and all this problem going on, right? So now what happens is that MTN's inability to liquidate or to be liquid at that point of time can affect the price of the shares of the company or the price. So that's number one. And this is from a micro economics, okay? Not macroeconomics, but from microeconomics. So
a company's ability. So number one is company's ability to pay its debts.
No, company inability to pay its debt and its operational cost. That we call it a lack of capacity to be liquid. So the company is not liquid, right?
Yeah.
So if the company is not liquid, it means that the company cannot pay its debt on time or can't pay its debt at all, and plus the company cannot pay for its operation cost, right? So that means the company is not liquid. So if you hear on the news and people say, oh, that company has been liquidated, so by XYZ company, it means that there is a company who just bought the whole company and paid for all the costs and debts that company was not able to pay for. All right, that's what we call a company liquidated another company. If we say the company is not liquid, it means this company is not able to pay for its debts or for its operational cost. So therefore, it is not liquid. So it is drawn into debts or drowning into debts. So now, this is one thing, but this is from a micro, because whenever we talk about microeconomics, we're talking about factors affecting the company's growth. It is the company on its own, okay? But when we talk about macro, we talk about the economy from its own from a general perspective.
From a general perspective.
Yeah. Yeah. So now that's the point. Number two thing that can also affect prices, it is institutional positioning. So, okay, so the market position of the institution, how much market this company owns. You understand? So how much market this company owns. So those are the things that can be a problem, that can affect the price of a stock of a company, for example, in a marketplace, right?
So like, how much of the market, percentage of the market, do I affect? Is geared towards me. How are you saying that?
Okay, what I mean is this, like, let's say, for example, I'll give an example, Apple, right? Apple has larger market capitalization, right? It owns large of global market when it comes to technology, right? Or electronics, more especially in the cell phone, space. So because of that, the stock price of Apple is way expensive to buy. One stock price of Apple, right? It's way expensive to buy. Now, I'm not going to get into numbers here because I don't want us to get very technical. But the deal is, because Apple owns large market, its stock market also, its stock price or share price per stock is also very, very expensive. Now, if, for example, you're talking about M-Pesa, for example, in Kenya, right? M-Pesa compared to Apple owns more stock, more market than M-Pesa. So now M-Pesa's price or M-Pesa's stock price will be cheaper than Apple's stock price. Am I making sense?
Yes, actually, yeah. So the more market, not just on, let's say I'm in multiple markets and I've captured a large part of that market. That means my share price will also go up. But the less market I've captured, let's say the less market I've captured, the more my market reach reduces, the less my stock price will go.
Yeah, it's close to what you're saying, but let me put it in a different way. How much does it cost? How much does it cost the cell phone, iPhone 17, for example? Let's give an example. Right? So iPhone 17 is around 1,000 something dollars, right? Why? Because it's new and everybody wants it. Right? But now, how much it costs iPhone 7? Maybe around $200, $300. Why? Because not many people want to use it again.
That was okay.
Do you get now?
I get now.
So that simply means that the price of an item is set based on its demand. You see? The price of an item is set based on its demand. If the item is demanded a lot, that means there's a lot of market for it, looking for it, then the price is greater. But if the item, there's less market looking for that, then the prices will reduce. Well, this is just outside in the marketing space as well. We have a technique which we use when it comes to entry price and maturity price, all those kind of things. We know how we juggle around that. Yes, but when now take this analogy to stock market, right? So if a stock of a company, okay, is very high, the stock price is high, it means that company has a very solid market positioning. It owns a huge market for that price to be high. So people want it, people look for it. If this company owns very, very little market, right?
Yeah.
They cannot sell their price also of their stock also high. Okay. And here I'm talking about the public offering. I'm not talking about private share, offerings. I'm not talking about private share offering. I'm talking about initial public offering. So you're on the stock market, like your Kenyan stock exchange or your New York stock exchange. Like once it is there, the price fluctuates of a stock fluctuates based on how much market that specific company owns. Now, number three, it is the interest rate. So now interest rate changes can also affect the company's your investment. So if you I mean the interest rate. Okay.
The stock or the
No, in your investment can also affect your investment. Because if, let's say, for example, you go to a bank and you want to borrow or you want to invest, for example, either way, if you want to borrow money and the interest rate is very high, you're not going to be able to get the money. Because the returning of that money, it's going to be a crazy deal for you because of the interest rate. And now interest rates are affected by what? By macroeconomic factors like, for example, inflation in the economy. You get what I'm saying?
I get what you're saying.
So now, these things is that you as an investor, right? If you're going to invest in a stock, for example, you're going to invest in a company, for example, the first thing you want to look into things, you want to look at the microeconomic factors that are affecting the company. Is the company liquid, right? Is the company able to pay its debts? Is the company able to pay its shareholders? Is the company's equity share price, is it stable? Is it high or is it low? So you're looking at this point and you look at the positioning of the company in the market space. How much market share this company owns, right? Because all this will affect your investment. You may invest in a company that is not liquid. This is the reason why, for those who like to watch Dragon's Den and all these TV reality shows, they will always rely on businesses that have sales. So they check that sales. Is it selling? Is it making money? How much did you make money? So because once the investor understands that part of the business, that they're actually making money. They look at the margin of your product, how much money you're making, how much money you're spending. So once they look at all that, they know that you are able to return their money back in the specific time. So they don't just ask questions in vain. You understand?
So you said capacity, the liquidity of a company, institutional position of the market. That means how much of the market is actually going towards that company. In short, how many people are actually buying their products compared to other companies, competitors, and then interest rate charges. The interest rate.
Yeah, interest rates. Yeah, interest rate that includes your taxes, includes your interest that you pay for your debts that you get from your investments. Like if you are doing, for example, your compound investments or your single direction investment, all these kind of things. Yeah.
Two of these things are. One of these things is internal because liquidity is usually internal, and then the institutional market position of the market and the interest rate charges are external.
I can't hear you. You say?
I'm saying, like the first one,
Yeah.
the liquidity of the company is internal, and the institutional position of the market, institutions' position in the market, and the interest rate charges are more external.
Yeah.
Ah, see, we learned something new today, guys. But stick around with this, but you're gonna learn something. So I think
But now, now from this is just from you as an investor wanting to either invest in the stocks in a specific company, or you're looking at understanding, you know, where your investment's going, and if, for example, you're gonna get money back. Okay. But from a trade investor, for example, like say, let's say from someone who is in the stock market, for example, who is a broker, is a trader, and is working on investment of other people, they also look into things. They also look at the algorithm. They look at the market sentiment cycle. You know, those are the things that they look into. So how people buy, how people engage with the product. You know, what is working in the market and what's not working. You know, so those are a lot of other things that they also look from a macro perspective when it comes to investment. But I would always advise for a new investors, the first 3 points are very important. Look at the interest rate on your investment. If it's not good, it's not making you happy, don't get it. Interest rate that you get on the debts as a company, the same thing. Liquidity ratio, like if the company is not able to pay for its debt and operational costs, then it's useless. You need to find someone to liquidate first, and then you can be able to invest in it. And then the third point, which is your positioning of the company. How is the company positioned? How much share it owns in a specific place? But remember, you may be a company and you're operating in different markets, right? So you can be Apple, you operate in Kenya. Apple is also listed in Japan. Apple is also listed in South Africa. In all these places, the price is never going to be the same. Okay, so because it's made of company positioning. That's why I told about institutional positioning, right?
Yeah.
Apple might not be the best company in China, so you cannot expect in China, if Apple is listed in the Chinese stock market, to have the same price as in USA. It's not going to happen, right? So in the USA, the stock price of Apple might be higher compared to the stock market price or stock price of Apple in Japan or in China, because of the market share ownership. So that is those are the very important things to look at as investor. That is why if you want to buy a share of a company, maybe look for that same company in a market that the price is lower. So then you can, for example, go, instead of buying Apple shares in the New York Stock Exchange, go buy it, for example, in the Kenyan one. Why? Because in the Kenyan one, the price is lower, for example, right? Yeah, you know. So and the currency is in your country's currency. So you're not going to pay as someone who's buying the same amount of shares in the USA, because the currency is different and the price is higher because of the market ownership difference.
I think that actually goes on to the next question. How does now, like, let's say, supply and demand dynamics create market opportunities?
I mean, that's how market is created. Is these two very important things, supply and demand. Okay, so if there is no demand, then who are you supplying to? And if there's no supply, how is the demand going to be met? Right? So we need both of them in order to create a market, right?
Yeah.
So now, the thing is that we need to understand three things.
That's very simply put.
Yeah, this is very, very easy to understand. So even for entrepreneurs, why are you not running your business and let's say, why are you not getting a market? It's maybe because your product is not a demand in that specific place. Find a place where your product or service is in demand, and then you are able to meet the demand. You see? So this is a parenthesis I'm opening, that if your business is not working or is not moving in Kenya, doesn't mean your business is crap. Doesn't mean your business is not good. It simply means you're in the wrong market. Okay? You're just in the wrong market. So you need either to create your own market or move your business to a different market, to a different place, right? So yeah, these are just things that sometimes entrepreneurs, we do not actually think of. Now, three things that you need to understand when it comes to what opportunities rises when these two things meet. How do you create a market? Number one, panic selling creates undervaluation, right? When you have a business and you sell under a desperation feeling, like you really just want to sell, you're trying to create a market for yourself, and because you just want to sell, you don't want to actually sell it as the level which your product or service is valued, but you just want to sell because you want to create a market, you want to meet a demand in a space that maybe your product is not as much in demand. So now this is created many times where you are in a market that is saturated. People tend to always sell in a lower price or use this panic selling technique in order to sell their product and create their own market. But remember, once you apply that, it means your product will be undervalued. You're not going to sell the same way as someone who is in a non saturated market, right? So that's number one. Panic selling creates a product that is undervalued. So you will have to try to like get into a space that is already saturated and trying to sell and trying to make money out of that. Number two, institutional accumulation, or in other words, institutional positioning can also make you create or build a market or create a market and a demand, meet that gap. Okay, so when a company is positioning or is positioned in a very good level, properly in the market, great brand, great message, great product, is meeting the demand, is meeting the needs, then you create a market. Okay, so if I started a new product or I launched a new product or a new service, and it's positioned properly in the market, you create a need, you create a market for yourself, you earn market, you sell, you meet the demand. Okay, so these are the two first things. Okay, so panic selling can help you create a market, and number two is positioning a product properly can also help you meet the market demands. Number three, it is structure shifts that changes sector attractiveness. In other words, you need to continuously work on the structure of your offering, of your investment, of your business. Work on the structure to meet the changes in the market. Okay, so if you don't sit up well with the changes that the market brings, that your market brings, you're going to lose market, you're going to lose attractiveness, you're going to lose the competitiveness that market is coming up with. And your competitors are going to fly while you're still there. These are things that Sony Ericsson, for example, have had in the past. These are things that Nokia has had in the past. These are things that Motorola's have had in the past. These are things like what? Tata, for example, car manufacturing space had in the past. So these are things that even Ford had in the past. So because, they did not meet the changes, they did not flow with the changes that were affecting their market. And this is very important, to create a market opportunities, you need to have these three things. Number one, apply the first technique, which is panic selling. Okay, panic selling.
Panic selling.
Have that. Number two, you need to apply institutional positioning of your service or product. Great positioning of your service or product. Branding. Brand it to a point that it speaks to the clientele that you are targeting and it solves their problem. Okay. And number three, it is your structure shift. Shift up structure. Work on the structure. Always meet the demands of the always changing environment that where you are. Otherwise, if you don't get these things, it's just going to be a crap in and out. You're not going to be able to meet up with the demands, and you will lose market, and you will have no market to sell to.
Okay. So go where your product is appreciated. The position, your market may not be in the place that you think it is. I think, and then after that, panic selling, and then structure your offering. How does your offer? There's so much to unpack. I don't think 40 minutes is actually enough. I think there are so many questions that are going to come after this. But anyway, since now we're on the last part, I think we can ask what behavioral economic principles explain short-term market chaos, and how do you identify them? Like, yeah.
So I didn't get your question is on what behavioral economic principles explain short-term chaos.
Yeah, the you see short-term market chaos, those two, what's it called? Blips that happen in the market that create chaos. What are some of the things that you've identified behavioral wise that can lead to such market chaos? Yeah.
I think there are a few things that I'm going to mention here. So it is important to understand that markets fluctuate. Okay, markets are never stable. But there are cognitive biases that create markets volatility, or that makes market to be the way it is. Number one, it is your herd behavior. The desire to buy, desire to be to be able to get product, the desire to be able to sell. Number two, it is your loss aversion. Okay. There is another one that also I love. It is overconfidence bias. Sometimes being overconfident also can be an issue here. All right. And then you have also another point, which is the recency bias.
Okay.
Recency bias.
Recency bias.
Okay. I don't know how am I going to explain recency to you. I need to find a proper way, simple way to explain recency. But it has to do with
what we're gonna do. A big question. I know, like, a guy Lusimadio is a very busy guy. He's a very busy man. Like, he has so much to do. We actually this 40 minutes of his time is actually more than he can take to do. But what we can do, we can, for all the questions that are going to come, actually, because I can see so many questions coming. Wherever we're gonna post this, we're gonna post this on LinkedIn, we're gonna post this on Facebook, and we're gonna post this on YouTube. Any questions that you have, please do not hesitate to ask. Lusimadio is actually he's a very responsive person. He's an investor. He has a wealth of experience in terms of anything that you want to ask. And since right now we're a bit pressed for time, we don't want to take too much time. But at the end of the day, tomorrow he'll still be here. We want to say in last words, Lusimadio, before you go.
Yes. No, thanks. And I think the last point is when I was mentioning on recency, another point that came to my mind was missing the fear of missing out also could be, it also could be one of the things that affects short-term market chaos. These are the principles that really are very, very powerful that we need to look at. Try not to invest when you feel those hurt behaviors, or when you have like loss aversion feeling, overconfidence. Don't do that. It's always good to be very, very ascertain of what you're doing based